Is that one of the key levels to be watching out for?
That's what we're aiming for, and that's a 2013 high. So as long as we manage to stay above 5,200 points, it does look like that's the next mark for the market. Today, though, so quiet. Only $3.5 billion worth of stock being traded, but it was a positive one, and there was lots of data to absorb. From China, we saw industrial production coming in at 9.5%, just beating expectations of 9.4%, and retail sales coming in below expectations at 12.8%. The market expecting 13.3%. But domestically, we saw business confidence, and these numbers saw a surge, a reading of +6 from a previous read of -3. And that's the highest reading that we've seen in 2 years since May 2011, although business conditions still remaining quite weak with a read of -6. So it does look like business confidence on the move again. So let's hope that this is the start of a new trend. And in terms of the markets, while we did see a bit of a mixed performance with materials and financials holding up our market today, the defensives continue to underperform. We saw losses in healthcare, in utilities, as well as in properties. So while there was no clear trend, it does look like defensives still underperforming the market, and that's something we've gotten used to over the last month.
We saw some more China data out today, stronger than expected, particularly the industrial production fits into a growing picture of relative resurgent strength out of China, coupled with some good European numbers. Is now the time to be building exposure to growth stocks, to be maybe rotating from defensives and yields into growth?
Well, this is a theme that we've been talking about for a while, and investors have been moving from defensives into not only growth stocks, but also some of the smaller parts of the market, the small and the mid-cap stocks as well. And on Your Money, Your Call, you know, for the last few months, we've been getting a lot of questions on large caps, but suddenly we're getting a lot of questions on small cap stocks. So it looks like risk appetite really coming back to the market. And that's, I think, because of a number of factors. As you mentioned, global growth looking better because of those numbers coming out of China. We've also seen slowly better numbers coming out of the US as well. And here domestically, if we have a look at the earnings cycle, that looks like it's at an inflection point at the moment. So the last 3 years, we've seen negative or flat earnings growth. That picture now looks to be turning, and we're looking to see growth. So that's an important part of the equation, because when we look at valuations on the market, while they may look expensive from a historical perspective, if we see earnings picking up this year, then we'll see those PE ratios and those valuations once again dropping.
The corporate news about Elders, Julia, refinancing debt facilities, extending it out a little bit longer, helping to, with their shift to a new business model, 10%, potentially 10% of the workforce to be cut. Shares significantly higher, albeit off a rather low base for Elders.
James, a lifeline being held out to Elders today. So it's received refinancing until the end of 2014, and that buys it a little bit of time. That means it's going to take its agribusiness off the market, and I guess it's a difficult time to be selling a business like that. But if we have a look at conditions in the agriculture space, we know that Elders has a large leverage exposure to things like wool and cattle, and this is a market that's still quite subdued in that area. There's still soft conditions in terms of farm supplies as well. So it's a very difficult business to be in. We did see the shares shooting up 10% today, and that's really because of the refinancing and the lifeline that's been held out to Elders. But I think in terms of an investment, this would have to be classified as a speculative play. It's still a very difficult environment for a company like Elders to be in this type of market, and it still has a fair amount of debt on its books given its market capitalization. It sold its futures company back in August, and that means debt's down at $272 million, but that's still way too much for Elders. So today, a bit of a bounce on the back of that lifeline and the refinancing until the end of 2014. The lifeline just being extended there for Elders.
It was being watched to some degree. One of the owners of one of Sydney's Cross City Tunnel. This thing, since beginning, has just been beset with problems. I actually travel through it on the way to work, but I'm not the only one, it appears.
I think the problem with these toll roads is the much too optimistic traffic estimates when these things were built. And if we have a look at the Cross City Tunnel today, an article in the Australian Financial Review pointing to perhaps receivership. And of course, that would be the second time for the Cross City Tunnel. It's a 2.1 kilometre road. It barely gets used. It was built at a cost of $1 billion. It opened back in August 2005, and it only took just over a year for it to go into receivership in late 2006. And of course, the consortium with Leighton's, RBS, as well as ISA picked it up for around about $700 million. We have seen Leighton's already writing off a lot of its toll road assets, but toll roads have not been a good area for Leighton's. If we have a look at Bris Connections and now the Cross City Tunnel, it's been a really difficult area. But I don't think we're going to see a material reaction by Leighton's share price today. The stock actually trading ex-dividend, but managing a rise of 0.9%.